When you start a company and you're a founder, you're taking the most risk. You're the person with the idea. You should be justly rewarded for that. The way that happens economically in a company is you get founder shares. The basis of those founder shares are effectively zero. And you're able to do a bunch of structuring when you first start a company that gives founders specifically some incredible tax advantages. You can, do an 83B election, which is effectively you buying the stock, starting the clock on long-term capital gains, et cetera, et cetera. Then you have stock that you give to employees. They're one of two kinds: non-qualified stock options and incentivized stock options, NSOs and ISOs. And, those have different tax treatments. But again, when you're a very early employee, you get a mixture of these things, also hugely accretive. It has a very low basis. You're building value. But here's what people don't understand. When a venture investor like myself or Jason...
Explain basis, by the way, for people. For the basis,
a very low cost basis. The price of your stock is effectively zero.
Paying a penny for it or something.
Yeah, like my stock at Facebook costs like half a penny.
Got it.
Whatever.
It goes public. It's $15, $20. You get the spread. Got it.
You get the spread, and you pay long-term capital gains on that if you've been able to.
Not income tax. Yeah.
And shift it to long-term capital gains. Okay. So now Sachs or Jason or myself come and invest in your company. What happens? We actually don't get equity. We don't get common stock. We actually get a synthetic form of debt called a preferred share. Okay? And typically the way that it works is when we invest in a company, and this is how the entire venture ecosystem works, we actually create what's called a preference stack, which means we get an instrument that is senior to the common equity. Now, what does that mean? Well, it means that if your business goes out of business, we get our money back first. We also get an interest rate, and we're able to convert all of that at some point, the magical moment when a company goes public, into common stock, and we give up our preferred rights, and we now have the same instrument as everybody else when a company goes public. That's the typical mechanism.
Why does that exist, by the way, the preferred shares? Maybe explaining the why. Why do VCs need that protection?
To be honest with you, I don't know why it started, but it's a historical artifact of, the 1960s and 70s.
I think I know why it started.
Go ahead.
Okay, so this got lawyered because let's say you start a company, and just to use some round numbers, a investor wants to give you $10 million to start the company, and for 10% of the company, $100 million valuation. If you didn't have preferred shares, then the founders could basically, on the day after the money comes in, could say, hey, we want to liquidate the company. We decide we don't want to do this anymore. And they own 90% of the company, and they could basically then distribute out the 10 million to all the shareholders, and they would keep 9, and 1 million would go back to the investor.
Correct.
So that's why lawyers came up with this idea of seniority, so that, okay, if you disband the company with the investor's money still in there, it goes back first to the people who put in the money. That was the idea.
And the second piece was, if the company gets sold for less than the cash put into it, at least the people who put the cash in get their money out first. Right. So if it sells for 10 million, you get your 10 million back. Or if 11, you get 1 million after that. Yeah.
So let's just say Jason does the first million. So now there's $1 million of preferred. Then Sachs does the Series A and he puts in 10. Now there's 11 million of preferred, even if it's at a much higher valuation. And then I come in and I give 100 at an even higher valuation. So now there's $111 million of preferred shares. Now, if the company goes through all kinds of complications and mess, and let's just say we have to sell it to somebody else for $200 million, well, guess what happens? The first 111 of it comes back to myself, Jason, and David.
Plus interest.
So this is why venture investors have an incentive to pay and set these crazy valuations, because they don't really care what the valuation is as much as they care how much of all this preference is building, and do I rationally believe that the liquidation value of the company is at least that much money. So if I think that Friedberg's company is worth at least $111 million, I'll do it, and I add my 100. Now, why is this important for employees? Before you join a startup, especially in this moment, I think it's very important for you to understand how much money have they raised? How much is this preference stack that exists? And do you believe that the company is going to be worth much more than that? because that's the only way that you're going to actually participate in the equity. And we know now what the public markets say. So if you go back to that tweet, if it's a 10 or an $11 billion company, okay, well, you need to generate $2 billion of revenue. And if you're at 100 million, that means you have to 20x the revenue for the valuation to be worthwhile, for you to believe that this valuation is real. So this is just a little guide for employees. I just think it's very important that you guys start to do the math and start to figure this out. Ask the hard questions.
How many shares are outstanding? How many preferred shares? What's the overhang? What's my strike price?
What's the preference stack?
Yes.
How much is the total pref stack? How much revenue are we generating now? You should go and do the work to figure out what the public market comps are. Those are widely available. Hopefully somebody could actually just create a website that helps you do this. But all of these things are going to be very important for you. Otherwise, what will happen is if you join a company in this moment at a fake valuation and the valuation gets reset, you can effectively assume your options are worth zero. So if that was an important part of how you made the decision to join that company, you're being somewhat misled in a moment like this. And you need to have your own rational sense of what that company's worth. Conversely, I think boards and CEOs have a real responsibility now to do the hard work of resetting this and explaining it to their employees if they want to retain them. Because in a moment like this, if you have a valuation reset, you don't allow people to understand it and you don't figure out a way to allow them to participate in some incremental way, I think it's going to be very problematic for employee retention.
You're good.
In those contexts, look, there's a couple of things that I always support. If you need to reprice the options, you can reprice the options and give employees the benefit of a new 409A. So the company doesn't set the option price. That's set by an external 409A audit. But if that 409A goes down because of these factors we're talking about, you can basically, the board can vote to reprice everyone's options, so at least they get the benefit of the lower 409A.
Explain what a 409A is, just broad strokes.
It's basically when stock options are issued, the law requires that the strike price of the option be the fair market price. And because of some accounting shenanigans a while back that got companies in trouble, it is now the case that companies don't determine their own fair market price. They go out and you get some external auditor to do a 409A audit, and then the 409A, that gives you the fair market price. And specifically, it's the fair market price of the common stock, because what investors are buying is the preferred. Because of the dynamic that Chamath is talking about, where the preferred gets paid back first, the common stock is worth less per share because it's got this overhang on
typically
top of
a
it.
fraction, a fifth, a tenth, something in that range is typically. So if the shares were worth $1 of preferred, the fair market value of the common could be 5 cents, 10 cents, 15 cents. Depends on if the company's going to run out of money, how many months of runway they have, are they profitable? And so it is a fair thing to do. But you have to know that. And in a down market like this, if you had massive compression, boards need to look at that. Founders need to look at it and say, hey, listen, if the SaaS multiples come down so much, well, our fair market value should come down that much. The fair market value might be worth 50% less, 75% less. Correct, Sachs?
Yeah, I mean, so the way it works is that when a company IPOs, you get rid of all the different classes of stock. Everything, basically the preferred converts to common in an IPO.
One class of shares. Yeah.
Yeah, maybe you have like the dual stocks so the founder can maintain control, but from an economic perspective, you basically collapse into common stock. So when you IPO, common and preferred are the same. And so economically, they're converging to one as the company gets more and more mature and heads towards an exit. The earlier that you are, the riskier the company is, the more that the pref stack matters, the more overhang that creates. But the benefit to employees is it creates a larger discount on their strike price on the 409A. So that is the offsetting benefit. If the 409A goes down because the market's changed, then the board can vote to apply a new 409A to the employees. That's a beneficial thing to do for everybody. So that's something, I've always supported. The other thing is that if you're in a turnaround situation where you're actually worried that the pref stack is larger than the value of the company, in other words, more money has gone into the company than the company may be worth at exit, then what you need to do, because then there's nothing for the employees, there's no incentive anymore. What you need to do is create basically an employee participation. You create a corridor where you say, okay, 30% of any acquisition price for this company is going to go to the employees. You create a management or employee carve out. Really, it should be an employee carve out, not just management, but all the employees of the company should benefit from an acquisition. And sometimes you'll see boards be either unrealistic or stingy. They'll be kind of penny wise and pound foolish. They won't create the incentive for the employees to get that sort of overcapitalized company across the finish line. And, it can be pretty frustrating to see when that happens.